Very good morning. Yes, very good morning, students. Are you able to hear me? Very good morning. Very good morning, everyone. Yes, very good morning. चलिए, those who have come, very good morning. आ जाओ बेटा, सब जन जल्दी से आ जाओ. Very good morning. Okay, morning, Avisha, Arya, Shreya, Vaishnavi. Very good morning. Very good morning. Very good morning, all of you. Yes, we'll wait for a minute. Let everybody join. Then we'll be starting with today's revisions. Today is again going to be a big session, a big day. We'll be revising process costing, joint and byproducts. We'll be also revising today. That is like marginal costing. Okay, so which is again a very huge chapter, right? Marginal costing. So we'll be revising that today. Very good morning, Avni. Very good morning, Prasanna, Shreya. Sanmitha, Bharat, very good morning. I'll wait for 2 minutes. Let everybody join and then we'll start. Okay. We'll wait for 2 minutes. By 9:35, we'll start. Okay. Perfect. I hope all of you are revising. Yes. Hello, Shri Raksha. I hope everybody is working on their own also. If you have any difficulties, keep in touch. Okay. Keep on sending your queries. Very good morning. Very good morning. I hope now almost everyone has joined, I guess. Do you like the video? Okay. And let's proceed ahead. Okay. So now, today we are going to revise process costing. Then we'll be doing the joint products and byproducts. And the third thing which we are going to start today is going to be the marginal costing. The topics are big one. Joint product byproduct thoda chota hai, lekin process costing and marginal costing, they are big ones. Okay, so they are big ones. So we'll be spending time on that. Okay. Yes. Very good. Very good morning, Kirti. Here. Okay. Perfect. Yeah. Sure. Let's start. Okay. So first of all, the first concept for today is process costing. Okay. Process costing is basically where the goods are produced in a sequence. Okay. Where the goods are produced in a sequence, like if you input the raw materials in the first process, then you will get something. Okay. If you put the raw materials in the first process, you will get an intermediary product which will be transferred to process 2. Okay. Then after that, it will be transferred to process 3. Okay. And then ultimately from process 3, the output will be transferred to the finished goods. Okay. The goods will get ready. So this is how process costing works. Okay. Introduce the raw material in process 1, apply some labor and expenses, then whatever the output is will be transferred to process 2, apply some material, some labor and etc. Whatever the output of process 2 will be transferred to process 3, and then whatever the apply some material, some labor over here, and whatever the output is will be transferred to ultimately the finished goods. So this is how process costing works. And process costing, because we have seen that there are so many processes involved in over here. Okay, because there are so many processes involved. So what you have to do is Understand, because there are so many processes involved. So generally what we do is we make the process accounts. We make process 1 account, we make process 2, we make process 3 account, like that. Okay, so we'll be making process accounts and we'll be debiting all those accounts with the expenses and crediting the output. Okay, whatever the output is that is going to be transferred to the next department will be credited. So this is how process costing works. Okay. Now in this process costing, there are some concepts of like normal loss. We have them abnormal loss. We have abnormal gains also, right? So these are the concepts over here. If I talk about normal loss is something which is already expected, which you knew that is going to happen. Okay, it may or may not have some scrap value. Okay, it may or may not have some scrap value. But always remember the rule: if you realize anything by selling the normal loss, that basically normal losses are to be valued at the NRV and they have to be reduced from the cost of the production. That's a very simple rule. Normal losses, scraps basically are to be measured at NRV and they have to be reduced from the cost of production only for normal losses, not for abnormal losses. Abnormal loss is over and above normal loss. Suppose, for example, if out of the input you were expecting that the loss will happen for 200 units, but the loss actually came to 250 units. So the excess 50 units is nothing but an abnormal loss. Okay, that is going to be transferred to the costing P&L account. Similarly, suppose you were expecting a normal loss of 200 units, but you got a loss of only 180 units. Okay, so 20 units were saved that were called as an abnormal gain. Okay, they are also transferred to costing P&L. But I'll tell you one thing: whenever you are transferring abnormal losses and abnormal gains to the costing P&L, always net it off by scrap value. Okay, always deduct the scrap value of the losses as the scrap value of those units and then transfer to the costing P&L account. How this works, I'll tell you afterwards. Then in this chapter, we have that valuation of work in progress and everything. Okay. But before proceeding to that, let me show you how exactly this process costing works. So this is your, again, I say material. Okay. Now see this is the illustration number 1. I'm just showing you. We are not going to solve this. It's very simple. This is very, very simple, in fact. So there is nothing to solve in this. Okay. Yeah. If there are some bigger problems which will have the normal losses, and abnormal gains. Again, if something interesting is there, we will solve that. Okay. So if from the following data, prepare process accounts indicating the cost of each process and the total cost. The total units that passed through each process were 240 for the period. Materials in process 1 we will introduce 150, labor 80, other expenses is given. Then process 2, data for process 2 and process 3 are given. Indirect expenses amounting to 85,000 may be apportioned on the basis of wages. Okay, so 85 is to be distributed in the ratio of wages between the three processes. Now, how will I make the account? So process 1 account, whatever are the expenses, simply write on the debit side. Okay, simply write on the debit side 150, 80, 26. You can see 150, 80, 26. So I have written the material, labor and other expenses. I've got the total columns. Sometimes we make the per unit column. This is not made every time. Okay, this is not made every time. So total, with this we have taken, and this indirect expenses, what are there? They are actually apportioned on the basis of wages. Okay, so 80, 2 lakh 60, total is going to be 3 lakh 40,000. So out of 3 lakh 40,000, 80,000 is over here. So we'll make proportionate, right? We'll make proportionate, and then we'll get the indirect expenses 20,000. This is a very simple thing, nothing much in that. And then this output will be transferred to process 2. Now what will happen in process 2? These are the three expenses that are going to be made, plus the share of indirect expenses, and plus the output transfer from process 1 that will also come to the debit side. Now see this. If this is the process 2 account, first is the output of the process 1 account, which is transferred to the process 2 account. It will come to the debit side. Then you will add the material, labor and other expenses, obviously with indirect expenses. And then this output will be transferred to process 3. And in process 3, now I need not even say what will happen in process 3 is, in process 3, you will write to process 2 account, right? So from process 2 will receive. So to process 2 account, some amount will be there, and this amount will be there obviously, and we'll add some material, labor, expenses and everything, and that will be transferred to the finished goods control account. See this. So to process 2, now this is process 3 account. So to process 2, we have added material, labor and expenses, okay, and then it's transferred to the finished stock. Obviously, this kind of such easier questions will never come in your exams. This is very, very easy, in fact. So this is not going to come in your exams, but there are some cases where you have the normal losses which are inherent in the nature, which are unavoidable. So normal losses are actually absorbed by the good units produced. Normal losses are actually absorbed by the good units produced. We normally use a formula for that. Abnormal losses and abnormal gains are transferred to the costing P&L account. Okay, now students, I'll take an example over here to explain you everything. Okay, I'm going to take an example. Now let's take this example in the class. We'll solve this. Okay, we'll solve this and we'll see how it works. Okay. So RST Limited processes product Z through two distinct processes, process 1 and process 2. On completion, it is transferred to finished stock. From the following information of the current year, prepare process 1, process 2 and the finished stock account. So you have to prepare the process 1 account, you have to prepare the process 2 account and the finished stock account. Now you can see raw materials use 7,500 units, raw material cost is rupees 60, and then you have this transfer to next finished process, finished stock, that is 6525 units from the process 2. Normal losses on inputs is given, direct wages have been given, direct expenses have been given, manufacturing overheads have been given, and there is something interesting, that is realizable value of scrap per unit. Actually, I have taken intentionally this example because this was having this realizable value of scrap. Okay, and I wanted to teach you something in this. 6,000 units of finished goods are sold at a profit of 15% on cost. Assume there is no opening or closing WIP. See, right now I'm not concerned with this, okay, that they are sold at a profit and all that. That is all part of the income statement. We are not here to make the income statement. If you ultimately, when you'll see the answer, they have made it, but it's not required actually. Okay, we want the process 1, process 2 and the finished stock account. Now, let us try to make the process 1 account, how it works. Let's try to make the process 1 account. Come on, students, you will also start making it with me, okay? Let this be the process 1 account, okay? And process 1 account, actually I'll require 3 columns, particulars, units and rupees. Okay, so I'm adding one more column over here, that is for units. So particulars, units, rupees. Now, in the process 1, I'm using raw material 7,500 units and the rate is 60 per unit. So, obviously I'll write to material control account, or I can say stores ledger control account, it is one and the same, to material ledger control account. How many units I have introduced? 7,500 units. And how much will be the amount? 7,500 into 60. Come on, do that. So that is 4,50,000. That's 4,50,000. Next, transfer to the next process is 7050. I'll come to that. I'll come to this afterwards. Normal loss is given 5%. I'll again come afterwards on this. First, I'll write the direct wages, direct expenses, and the overheads. Let's finish the easier part first. Okay. So direct wages, let's write. So I'll write to direct wages 135,750. This question is having actually everything: abnormal loss, abnormal gain. That is why we are taking this question. Okay. So to direct wages 135,750. Direct expenses are 60% of the direct wages. So to direct expenses 60% of the wages. So 135,750 into 0.6. So that is 81,450. Okay, that is direct expenses. 81,450. Manufacturing overheads are 20% of the direct wages. To manufacturing overheads, that will be 27,150. Okay, 27,150. Now, students, now we have to analyze the entire stock and all that. Have you all understood till over here? Have you all understood over here? Till over here? There's nothing much in this actually, right? Process one is there. I have, just added all the cost. That is materials, wages, expenses, overheads. Is it all clear? Kindly keep interacting. Yes, 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 yes. Okay, no, yes, no, yes, whatever it may be. Just keep on telling so that I can proceed ahead. Now, students, what happens is, after doing all this expenses, now we have to analyze. Okay, chalo, ab nahi aa raha, Abhijit, Malika, theek hai. Okay, so Shreya, so everybody, it is clear. Very good, right? So now we have to actually analyze the units. Okay, we have to analyze the quantity. Now this is something which is very crucial, and for what we are actually solving the problem. Students, now we have to make an analysis of the quantity especially. Okay, so we have introduced 7,500 units. How much we have introduced? We have introduced 7,500 units, out of which the normal loss should be 5% of the inputs. Okay, so out of this, the normal losses should be 5%. Okay, so what is 5%? 7,500 into 5%. So 375 should be normal loss. And what is the expected output? So 7125 units was expected output, right? This is what we were expecting, that the expected output should be 7125 units, right? This is what we were expecting. Now, but how much is the actual output? The actual output is coming 7050 units, right? The actual output is coming 7050 units. This is the actual output. Okay. Now, since this is the actual output, like we were expecting 7125 units to be produced, but the actual production was only 7050 units. So how much is the extra loss or the excess loss? So that is obviously 75 units, and this is abnormal loss. This is abnormal loss. I hope everybody it is clear. Like 7,500, this is the analysis of the quantity. Please understand this. I think there's some issues with the internet connectivity. Okay, I'll repeat this again. Okay, there was some issue, I guess, some lag was there because of internet connectivity. Okay, so I'll repeat this again. 7,000 units, 7,500 units were introduced in the process. 5% was the expected loss. 5% was the normal loss which was going to happen. Okay, so 375 was the expected loss. So I was expecting an output of 7125 units. However, the units actually completed and transferred to the next process was 7050. So this is what was the actual output. Now I was expecting this quantity, but actual was lesser. So there is an extra loss of 75 units, which is treated as an abnormal loss. Okay, now this is the analysis of quantity. Now students, after this is done, what you have to do is understand this. There is a normal loss, there is an abnormal loss, and there are some units which are transferred. What I'll do is, see this now, by normal loss, by unit, by process 2 account, basically these are the units which are transferred to the next process, and by abnormal loss account. By abnormal loss account. Understand? This is because there's a loss, that's why it has been written on the credit side. If it would have been a gain, I would have written it on the debit side. Okay, so by normal loss, see how much quantity was there in the normal loss. So 375 units was the expected normal loss. In the process 2, I have transferred 7050 units and 75 units were for the abnormal loss. Okay, so this is the loss, this is the quantity analysis. Now you can see my quantities will tally on both sides, 7500, 7500. They will tally on both the sides. My quantities which are there, 7500 on the debit and 7500 on the credit. Now, students, the next rule what you should understand is, after making this analysis, normal losses or basically the scrap values are always and always measured at their net realizable values. This is a rule you must remember. Normal losses of the scrap value, okay, basically the scrap value of the normal losses is always measured at NRV and reduced from the cost of the production. So see, the realizable value of scrap is 12 rupee 50 paisa per unit. Okay, I'm having 375 units. So 375 into 12 rupees 50 paisa. 375 into 12 rupee 50 paisa. The answer is coming 4687.5. Okay, so 4687.5. I'll otherwise what I'll do is I'll round it off. Okay, 4688 I'll do. Okay, 4688 I'll do. So understand how I have calculated 375 into 12.5. Understood this? Normal losses are always measured at their scrap values, always measured at their net realizable values. Okay, so that is 4688. 375 into 12.5. Now, students, what will happen is, calculate the good unit rate. Good unit rate. Sir, how to calculate that? The formula to calculate good unit rate is total cost minus NRV of normal loss, or I can say scrap value of the normal loss, upon total quantity minus normal loss quantity. This is the good unit rate. Total cost which is incurred, out of which whatever is the scrap value of the normal loss, reduce that, because that will reduce the cost of the production, divided by total quantity minus normal loss quantity. Now check the totals of the cost. So 4,50,000 plus 135,750 plus 81,450 plus 27,150. So this is coming somewhere 694,350. Okay, 694,350, out of which reduce this 4688. Reduce the scrap value. Okay, so the numerator I am receiving is 689,662. Okay, 689,662 is the numerator, and in the denominator, total quantity minus the normal loss quantity. What was the total quantity? 7,500 minus 375. Okay, so that will be 7125. So I am getting a good unit rate of 96.79466666 something, right? 794666666 something. This is my good unit rate. Now I must use this rate to measure the transfer to the next process into 7050. So that is coming 682,402. Okay, 682,402. And similarly, this one will come 7260. This will come 7260. Now you can check. It must tally. 4,50,000 plus 135,750 plus 81,450 plus 27,150. So this is 694,350. This also has to be this much. I'll just check. Perfect. So it is matching. All of you have understood how we are doing this? Have you understood the sequence? I have written first the other things like material, wages, expenses and everything. After doing that, what I did was, I first of all analyzed the quantity. I made an analysis of the quantity. After doing this, what I did was I wrote all the quantity like this: by normal loss, by process 2, by abnormal loss. So I have written the quantities. After doing that, always remember normal losses are to be measured at their NRVs, okay, and they have to be reduced from the cost. So normal loss I have measured at this NRV 12 rupees 50 paisa. I have reduced from the cost. So 694 350 minus this 468 4688. Okay, I have reduced this and I got the numerator 689 662. This was my total cost. Divide by total quantity minus normal loss quantity. Okay, and I got this. This is called as a good unit rate. We measure the units completed as well as the abnormal loss both at this rates only. We measure both of them at this rates only, 96.79466 something. So I measured them and the account got tallied. Now students, if it is clear, kindly say yes. If it is not clear, then please ask your doubt. If it is thoroughly clear, if you have understood everything, just say yes. If you haven't understood, if you have some queries, please ask your query. किसी को कोई भी दिक्कत है तो बेटा पूछिए. चलिए, नाइस नाइस नाइस, सभी को क्लियर हो गया है. वेरी वेरी गुड, है ना. अगर कोई भी दिक्कत है जरूर पूछिएगा. Now students, this is how we make a process one account. Now, so abnormal losses also we have seen, we have measured it at the good unit rate, and process 2 is also measured, the transfer to the next process is also measured at the good unit rate only. Okay, now we will try to make a process 2 account where there is going to be abnormal gain now. This was an abnormal loss written on the credit side, and this was also measured at the good unit rate only. Okay, this is also measured at the good unit rate. Now let's do process 2 account, students. Let's do process 2 account. So this is my process 2 account, students. Now this is my process 2 account. Obviously the columns will be particulars, units, rupees, particulars, units, rupees. Okay, so this is how it's going to work. Chalo. So what will come in the debit now? First of all, process 2 account will always start from the input from process 1. Process 2 never starts automatically. That will always and always start after receiving the input from process 1. Okay, so it is by rule, it is mandatory to write to process 1 in the beginning. This is compulsory. There is no option to this. To process 1 account should be in the beginning, because process 2 never begins. See, process 2 never begins before receiving the input from process number 1. Okay. Yeah. So to process 1 account, how much quantity and how much amount? So we have seen that 7050 quantity was received and 682402 is the valuation. So 682402 and 7050 quantity was received, right? 682402 and 7050 quantity was received. So I have started my process 2 now. On process 2, there is no material that is used. There is no material. but there is some wages and some direct expenses and some manufacturing overhead. So I'll write it fatafat. So 2 direct wages, 2 direct expenses, 2 manufacturing overheads. So 129250, 129250, 65% is the direct expenses. Come on, 129250 into how much percent? That is 129250, right? So 65%. So that is 84013, right? 84013. I have upward rounded, okay? So 129250 into 65%, 84013. Then 15% I want, 129250 into 15%. So that is 1387.5. 19387.5. So 19388. I've got a query over here. सर अगर एबनॉर्मल लॉस गेन कॉस्टिंग P&L जाएगा तब गुड यूनिट रेट माइनस एनआरवी इनटू एबनॉर्मल रेट पे होगा ना? Yes, Abhijit, I'll come to that point. Okay, I'll come to that point. I want to teach this to everyone. Okay, don't worry. I have actually in the discussion also I have told you this. Whenever you are transferring abnormal gains and losses to costing P&L, they'll always get netted off by the scrap value. Okay, they always get netted by the scrap value. I'll come to this point afterwards also. So 19388. Okay, now I have to make an analysis. They have told you that the 10% of the normal loss. So sorry, they have told you that the normal loss is 10% of the input. Now normal loss is 10% of the input. Now students, please calculate. Please make this analysis. Please make this analysis and calculate the gain and losses. Okay. So 7050 units were introduced. 7050 units introduced, less normal loss, which is 10%. Come on, I am not doing this. I am waiting for your answer. Okay, normal loss is 10%. Now you will get expected. You will get expected input. So sorry, expected output. You will get the expected output, and after getting the expected output, compare it with actual output, and after comparison, you will get abnormal gain or loss. You will get abnormal gain or loss. Come on. What was the actual output, sir? Actual output is 6525 units. Actual output is 6525 units. Okay, now everybody do calculate whatever is the normal and abnormal. What is the abnormal gain or loss? Come on, students, do calculate abnormal gain or loss. Very good. Arya, Avisha, Kirti, Sanmitha. So normal loss of 10%. Yes, very good. Shri Raksha, Shreya, you have got Sujan, Vaishnavi, Bharat, Kirti, Samita, Shiva Karthik, Tanushri, Siddesh, everybody, your answers are correct. There is an abnormal gain of 180 units. Okay, Shreya, Abhijit, your answers are correct. So 705 is this. Okay, so 7050 minus 10%. So that is going to be 6345. That is expected output, but actual output is 6525. So I'll get an abnormal gain of 180 units. Now, students, after getting that, okay, I'll just write the quantities over here. So by normal loss, by finished stock ledger account, by finished stock account and abnormal gains are written on the debit side. So two abnormal gain. Abnormal gain are written on the debit side. So this was 180 quantity. This was 705 quantity. Okay. And this is 6525, which is the actual output. Which is 6525, which is the actual output. Now, after writing the quantities, I must always know normal losses are measured at their NRVs. Okay. So, what is the NRV? NRV is 37.50 per unit. Okay. That is the realizable value of scrap. So, 37.50 per unit. Now, how much was the normal loss? So, 705 into 37.50. So, 705 into 37.5, it is coming 26437.5. So, I'll write 26438. Okay, I'm upward rounding. So, 26438. Okay, this is what I have written into 37.5, obviously. And then I've got the total cost minus the normal loss. I've again used the good unit rate formula. Good unit rate, the formula we all know. In the numerator, I want the total cost minus the normal loss. So 682,402 plus 129,250 plus 84,013 plus 193,888. So that is 9,15,053. Okay, 9,15,053 minus the normal loss minus 26,438. So it is coming in the numerator. I am having 888,615. Sir, how have you got this? I have taken the total of all this and subtracted the scrap value of normal loss. Okay. So total ले लीजिए और उसमें से scrap value of normal loss को हटा दीजिए. So I have done that, and in the denominator मुझे क्या चाहिए है? Total input minus normal loss. Okay. Total input minus normal loss. So 7050 minus 705. So that is 6345, which should be in the denominator, which was the expected output, right? So 6345. Now, so once I divide this, I'm getting 140.049 something. I can write 140.05 approx. Okay. Now I'll multiply this by 6525 units. So I get 9,13,824 something. Okay. 913,824. Okay. And abnormal gains are also measured at the same rate. The abnormal gain will be measured at 25,209. Okay, 25,209. Now let's check if the sides are tallying. So that is 940,262. This should be also this much only. Perfect. It is perfectly matching. Students, have you understood how we have solved this? So process 2 also we did the same thing more or less. Okay, we first filled in all the expenses, then we made an analysis of the quantities, and after putting the quantities, first of all we measured the normal losses at the scrap value, reduced it from the total cost, and we applied the good unit rate. Okay, the formula for good unit rate, I'll repeat the formula again. The formula is total cost minus NRV of the normal loss upon total input quantity minus normal loss quantity. Okay, I hope it is clear for everyone. If you are having any difficulties, please ask. Now I'll come to very important rule. See, normal losses and normal losses are always measured at the NRVs. Abnormal losses and abnormal gains are obviously transferred to costing P&L, are netted off by NRV and then transferred to costing P&L. Then transferred to costing P&L account. Now, sir, what are you trying to say by this? Let us say, for example, students, when we were doing the process one account, we had seen that the normal loss was 75 units whose value was 7260. Right? There was a normal loss of 75, abnormal loss of 75 units whose value was 7260. But understand, when I'll be transferring this, okay, there is the extra loss of 75 units. Don't you think this extra loss also I'll sell in scrap? This extra loss also I'll sell in scrap and I'll recover the 12 rupees 50 paisa. Are you getting the point? Like when we did this calculation, our answer was coming 96 point something. Like per unit, it is 96 point something. But students, what will happen is if I make an abnormal loss account, okay, I'll just show it to you how it works. Suppose if this is my abnormal loss account, okay. Suppose this is my abnormal loss account. Now what will happen? I'll write to process one, how many quantity? 75 units, 7260 rate, 75 units, 7260 as the rate. But what will happen is when I have to transfer to costing P&L, I'll not transfer the entire thing. Why not? Because I'll sell also by bank account, or if I'm making a non-integrated system, I'll make the by cost ledger control account, right? This 75 quantity I'll sell in the scrap at the rate of 12.5. So 75 into 12.5, that is coming 937.5. Let's say 938. Okay, I'll subtract this and I'll get 6322 only to be transferred to costing P&L. This is what we are trying to say. Like whenever we are transferring the abnormal losses or even abnormal gains to costing P&L, always reduce the scrap value. This happens in abnormal gains also. Okay, this happens in abnormal gains also. You always have to net off with the scrap value and then transfer it to costing P&L account. Is this clear? Abhijit, I think now it is clear, right? What you were asking. If it is clear, kindly say yes. If it is not clear, please ask your query. Okay. So students, after doing this, now, okay. Now students, after doing this, we must measure the production, okay. We must measure the production. Now what I'm trying to say by that? See students, right now you have been provided in the question that how much units were there in the closing stocks, how much units were produced and transferred to the next process, okay, how much was the normal loss and abnormal loss. But suppose if this data is not given, if there are some materials which are there in stocks, if there are some materials which are already there in the processes like opening work in process, closing work in process, and they are not fully complete, okay, they are partially complete with respect to materials, they are partially complete with respect to overheads and labor, okay, and some work is done in the previous year, some work is done in the current year, then how you measure your output, how to value them, how much quantity have you actually produced during the year, to analyze all this, okay, how to measure the valuation, how to do their valuations and all that. There is a concept called as equivalent production. Okay, there is a concept of equivalent production over there. So whenever you value work in process, it is going to become challenging. The previous questions were easy. Why they were easy? Because there was no WIP. There was no WIP. But now what will happen if there is some WIP? There is a concept of equivalent production. And we try to make a chart like this. We try to make a chart like this, like how much is the, like this is a complete analysis of the quantities. Okay, this is entirely a quantity chart. So input how much quantities in rupee, in units, obviously opening WIP how much, and units introduced in the process how much. Output quantity opening WIP how much, from opening WIP how much is prepared and transferred to the next process, from finished output. Okay, a new finished output is how much, normal losses were how much, abnormal losses, gains, closing WIP. This you all you have to return that they are completed by how many percentage and how many units equivalent. So this you have to do whenever there is some closing WIP there. Okay, whenever there is some closing WIP there. Now students, as you can see over here, this is the chart which we normally follow, but there are some rules. So what are the rules? Equivalent units for opening WIP. Basically this. We are calculating this only under the FIFO method. If there is no FIFO, if the method what you are going to follow is weighted average cost method, you do not have to make a breakup like this, opening WIP and finished product. Like for example, suppose out of 10,000, okay, out of 10,000, 2,000 was from opening stock and 8,000 is from the current production. So you have to make a breakup, like 2,000 was of opening WIP and 8,000 is the current year production, which we are transferring to the next process. But if we are following the weighted average method, we will simply write the finished output as 10,000, will not write the opening WIP line. We'll simply write that 10,000 units are produced, finish. Okay, that way. So opening WIP, for opening WIP, we always calculate using we'll always calculate it separate for FIFO. Under average method or weighted average method, we don't calculate it like that. Next, abnormal losses and abnormal gains are treated as 100% produced in respect of material, labor, and overheads. Normal losses are always written 0, 0, 0. We assume they are not prepared at all. They are not prepared at all. So this is how we make up a chart. Okay, this is how we make up a chart. Now I'll take a question. Obviously this is not easy to understand only with this chart. We'll take up a question and then we'll understand this. This is actually way easier. I'll take up a question. Students, let's come to question number, this is question number 2. Okay, let's come to question number 2. We will directly check with the answers. Okay, we'll keep on checking with the answers. Hill Manufacturing Limited uses process costing to manufacture water density sensors for hydro sector. The following information pertain to operations for the month of May. Opening WIP. Are there any normal or abnormal losses? No, it will not help. There are no normal and abnormal losses. Wait a minute. There are no losses actually, so it will not help us. It will not make us understand everything. We'll do one thing, students. We'll solve question number 4. Please come to question number 4. We'll be solving this with the help of the average method. Okay, we'll be doing this with the help of the average method. Now, there is some opening data given, 2,000 units, material cost is given, labor cost is given, overheads is given. Materials introduced in process 1, I'll solve it with you, don't worry about it. Okay, I'll thoroughly solve it with you. Okay, we'll be doing this, don't worry. This is important. Materials introduced in process 1, direct labor, overheads. Okay, so how much is the fresh input has been given. Units scrapped has been given, and what was the degree of completion, that also is given. Closing WIP is 2,000 units, their degree of completion is also given. Units finished and transferred to process 2 is 35,000 units. Normal loss 5% of the total input, including opening WIP, and the scrap units fetch 20 rupees per piece. Now, this is an important adjustment because I know this is the scrap value, okay, and scrap values of normal losses are to be reduced from the cost of production. You are required to prepare a statement of equivalent production. Okay, so students, let's make a statement of equivalent production. Now, how to make it, sir? Okay, I'll try to help you. First, particulars, units. Okay, particulars, units. Then, after that, again, particulars, units. Then I'm having for materials, and labor, percentage, units. Percentage, units. Now, this is my statement of equivalent production. Okay, what is this? This is statement of equivalent production. Now, with the help of this statement of equivalent production, we'll solve this. This is first of all inputs. This is units. This is output. This is units. Now I'm having materials and labor and overheads. For labor and overheads, the percentage is the same. So materials, let the first two columns will be for materials, percentage, units, labor and overheads, percentage and units. Okay, percentage and units. Now students, after doing this, how much was the units input? Opening, fresh. How much was the opening? Opening was 2000 units and fresh is 38,000 units. So 2000, 38,000. So the total input is of 40,000 units. The total input is of 40,000 units. Now students, always remember your inputs and outputs must tally. So if this is 40,000, this also has to be 40,000. Your input and output must tally. Now, because I'm doing an average method, what will I do? Units completed and transferred, to next process. How many were completed and transferred to the next process? So units finished and transferred were 35,000 units. I'll add the percentages afterwards. Okay, 35,000 units. Then how much is the normal loss and how much is the abnormal loss? Now he has told you that units scrapped were 3,000. Okay, there is some closing WIP of 2,000 units. Okay, there is some closing WIP also. Closing WIP, that is how many units? 2,000 units is the closing WIP. Okay, so I've got 35 and 2, 37 and total scrap of 3,000, out of which he has told you 5% of the total inputs including opening WIP is a normal loss. So how much will be the normal loss for the total input, which is 40,000? 40,000 ka 5%, right? So 40,000, 5% will be obviously 2,000, which is normal loss, and remaining 1,000 will be abnormal loss. Now you can see the sides are tallying. Everybody understood the analysis, first of all, of the quantities? So we have made this statement, okay, where we have written the units, and then obviously we have written the units, we have written the quantities. Now we have to write their respective percentages. We have to write their respective percentages. Now how we are going to write this? See this, for normal loss, first of all understand, for normal loss it is always treated as 0, 0, 0, 0. For normal losses it is always 0, 0, 0, 0, always. For units completed and transferred to the next process, if we are following an average method, then what you have to do is you have to take all 100%. All 100%. Now, so we have taken 100%, 100% in terms of material, 100% in terms of labor. For abnormal losses, he has given units which were scrapped, they have given 100% and 80%. Sir, units scrapped, this 3000 is actually having normal and abnormal loss both. But for normal, we always assume dash, 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 finish. For abnormals, materials are 100% and labor overhead 80%. So material are 100% and labor and overheads 80%. What do you mean by that? 1000 units was in the abnormal loss, so 1000 into 100% is 1000, and 1000 into 80%, that will be 800 units. 800 units, okay, like that. So we have to keep on multiplying and get the percentages. And with respect to closing WIP, I'm having 2000 units which are 100% complete in terms of materials and 80% in terms of labor and overheads. So 100% for materials, 100% for materials, so this will be 2000. And how much? 80% for this one. So 80% for this one. So that will be again 1600 units. Now take the total of this. So in terms of material, they are 38,000 units. Again, the pen is giving problem. I don't know why this happens in your lecture only. 35,000 plus 2400. So there is 37,400 units. Have you all understood, students, how we have to make the statement? How we have to make the statement? After making this statement, students, we have to make up one more statement, and that statement is for cost per equivalent unit. There's one more statement which we have to make, and that is cost per equivalent unit. Now, how do you make that statement? Computation of cost per equivalent unit. So we are having three costs: materials, we are having labor, and we are having overheads. We are having this three costs, right? Material, labor, and overheads. How much is the see, we are following weighted average cost method, so we must add the opening stock also. Opening stock, the cost was 80,000, 15,000, 45,000, 80,000, 15 and 45. This we are adding, remember, opening stock we are adding strictly because we are following average method. If we are following a FIFO method, this is not to be added. Current year. So what is the current cost? Material 14 lakh 80,000, labor and overheads. All three have been given. Materials, labor and overhead, all three are given. 14 lakh 80,000. We have 3 lakh 59,000. And this is 10 lakh 77,000. 10 lakh 77,000. So how much is the total cost? Come on, calculate the total cost, please. 80,000 plus 14 lakh 80,000. So that is 15 lakh 60,000. Then we have 15,000 and 3 lakh 59,000. So 3 lakh 74,000. Then we have 45,000 plus 1 lakh. So this will be 11 lakh 22,000. So we have got the total cost. Now after getting the total cost, just write the equivalent units. So for material, we know equivalent units were 38,000 and for labor, equivalent units were 37,400. So 38,000 for this and 37,400 for this. So what is the cost per EU? But there is one error which actually is there, and that error I will rectify right away. The error is I must reduce one scrap value of normal loss. See, whenever there is a normal loss and there is a scrap value, actually, okay, I'll come to your query afterwards. Okay, let me finish this. If whenever there is a normal loss and normal loss is having some scrap value, then you must reduce it from the cost. So what is the scrap value of normal loss? Always reduce this. Scrap value of normal loss, always reduce this. Now what is the normal loss? Normal loss was 2000 units. We have already calculated that was 2000 units. So 2000 units is actually fetching you 20 rupees per piece. So 2000 into 20, that will be actually 40,000 negative, right? So scrap value I must reduce always. Okay, remember that scrap value I must reduce. So actually, by mistake, I was doing all that pen stuff now that was giving problems. So I forgot that. Scrap value of normal loss always you have to reduce. Okay. And this scrap value you have to reduce, maybe FIFO method, maybe weighted average method. That does not change. Okay. So now 15 lakh 20,000 divided by 38,000. So this is coming exactly 40 rupees per unit. Cost per equivalent unit 40 rupees. Okay, this is not showing. Okay, cost per equivalent unit, this is coming 40 rupees. Now 3,74,000 divided by 37,400, I think it will be exactly 10 rupees. And 11,22,000 divided by 37,400, it is exactly coming 30 rupees. So this is my cost per equivalent unit. This is cost per equivalent unit. Like for 1 unit of material, I'll spend 40. For 1 unit of labor, I'll spend 10. And for 1 unit of overhead, I'll spend 30 rupees. Now, there was one query which was, sir, please explain abnormal loss equivalent units calculation. Okay, I'll explain that. Abnormal loss equivalent units production, see, they have given whatever the units there were scrapped. Material, in terms of material, they were 100% complete. In terms of labor and overhead, 80% complete. So this is a strange question, because almost in every question what happens is, if there is an abnormal loss, you always treat as 100%. But this question was very specific. You have to take 100% for materials and only 80% for labor and overheads. So what I did is, 1000 units were there, 100% in respect of materials, so 1000 into 100%, 1000. 80% in terms of labor and overheads, so 1000 into 80% is 800. Is it clear now? I just simply, whatever the percentages were given in the question, that units scrapped, material terms 100%, labor and overhead 80%. I've just written that and simply multiplied that. Okay, I've just written that and simply multiplied that. That is how I've done that. Next, so I've got my cost per equivalent unit. Students, I'll repeat this one more time. Opening stock I have added in this chart only because this was weighted average method. If this would have been a FIFO method, I will not add the opening stock over here. Okay, I'll simply add the current year expenses and subtract the scrap value of normal losses. Sir, we had scrapped more units, but beta, we have to subtract scrap value of only normal losses. We don't have to subtract the scrap value of all the losses. Now, we have got the cost per equivalent unit. Now, students, how do we measure? How do we measure the units completed and transferred to next process? How do we measure the abnormal losses? How do we measure the closing WIP? So, I'll tell you, it is very simple. I have got material, in terms of material, per unit is costing 40 rupees. In terms of labor, it is 10 rupees. In terms of overhead, it is 30 rupees. Now, if I have to calculate units completed, if I have to calculate the cost for units completed, see, in terms of material, it is 100%. In terms of labor and overheads, it is also 100%. So, for material cost, 35,000 units into how much? 40 rupees. For labor, 35,000 units into 10 rupees. For overheads, again 35,000 units into 30 rupees, right? Now, I'll simply get the valuation. So, this will be, I think, 14 lakhs. This will be 3,50,000. This will be 10,50,000. I think the total will be 28 lakhs. This is the valuation of the transfer to the next process. Similarly, if I have to value the abnormal loss, how many units are there? 1000 units for material and 800 units for labor and overhead. So, material 1000 units, labor 800 units, overheads 800 units. Rate, we have already calculated 40, 10, 30. So, 40,000, 8,000, 24,000. So, total 72,000. This is the valuation of abnormal loss. Now, students, can you calculate the value of closing WIP? Can you calculate the value of closing WIP? There are 2000 units in respect of materials and 1600 units in terms of labor and overheads. And we have already got the cost per equivalent unit. I've already got the cost per equivalent unit. Can you calculate and tell me how much will be the cost for the closing WIP? Come on, go for it. Closing WIP. Materials, labor, overheads. In terms of material, 2000 units. In terms of labor, it is 1600 units. In terms of overheads, also 1600 units. So calculate, come on. I hope, Avni, your previous query is clear, beta. Uh, check again. Bhavya, Samhita, Shreya, Samhita, your answers are correct. Materials was at the rate 40 rupees per equivalent unit, labor 10 rupees, and overheads 30 rupees. Bharat, Shikha, Kirti, Vaishnavi, all your answers are correct. This is 80,000, this is 16,000, this is 48,000. So the total is 1,44,000. The total is 1,44,000. Perfect. So this is how we measure the closing WIP. Okay. So this all calculations, this actually happens when there is this percentages and all that given. So I hope you have all understood the sequence how you have to do. You have to make a statement of equivalent production. I'm repeating the process again. Okay. I'm just repeating the process again. Okay. Please pay attention. This is crucial. First of all, we are solving average method. When we are solving average method, students, you don't have to do a breakup for units which are completed and transferred to the next process. I'm not doing any breakup for this. 100% straight away. Normal losses 0 0 0 0. Abnormal losses, if there are no percentages, 100 100. But in this question there was 100% and 80% specified of the quantities. Similarly, closing WIP 100% and 80% was specified. Okay. Now what I did, because this is weighted average method, opening stock I have to write their cost, I have to write the current year cost, and scrap value of normal losses to be reduced. So remember the sequence: opening stock plus current cost minus scrap value of normal loss. I get the total cost. Divide by the equivalent units which we have calculated above, and you get the cost per equivalent unit. And this, why we are calculating this, we will multiply this with this quantities to get the value of the units completed, to get the value of abnormal losses, to get the value of closing WIPs. Normal losses are anyways measured at scrap value, so that's not a problem. Okay, so this is how the process is. And whenever you will make a process account now, so you should know that when we write the entry for buy process 2, I'll write this figure. When I'll write buy abnormal loss account, I'll write this figure. Buy balance carried down, I'll write this figure, like that. Okay, so these figures will be put it in the process account straight away now. So that is the sequence. That is the sequence. Sir, if we solve the same question using FIFO, what will be the changes? If you solve the same question with the help of FIFO, then I'll have to make a change over here. Here I'll have to, this units completed and transfer, I'll have to make up a breakup. How much is from the opening stock? Like I'll write it like this: from opening stock 2000 units, and from current production 33,000 units. Okay, so I'll make a I'll make a change like this. I'll do one thing. In case if it is possible for me, I'll just show to you. If we are solving the same question, students, with the help of weighted average cost, then your answer will be like this: units completed and transferred, units completed and transferred from opening 2000 units, from current production. See, we have transferred a total of 35,000 units, right? We have transferred and completed 35,000 units. So opening stock was already 2,000 units, so that would have got ready, and 33,000 will be from the current production. Those which are current production, which are 100% done in the current year only. They are 100% done in the current year only. But see the units opening wale. Okay, see in the opening, we had 2000 units in terms of material, labor, and overhead. Some work was done. Okay, some work was done. Suppose, for example, material, in terms of material terms, they were 100%, labor terms 60%. Suppose if this would have been the question, suppose they have been completed like this. So in material terms, 100% work is already done in the opening. So I have not done any work in this one. 100% was already appearing in the opening. So zero work is done in the current year. I'll write directly 0, 0. For labor and overhead, 60% work is done in the previous year. So 40% work will be done in the current year. I'll just write 40%, 2000 into 40%, 800 units is done in the current year. This is how we make a breakup. Okay, if you are following a FIFO system, you must make up a breakup of how much is from the opening WIP and how much is from the current year production. So for opening WIP, only take that many percentage which has been done in the current year. So if material 100% is already in the opening, zero work in the current year. 60% labor and overhead already in the opening, so 40% work in the current year, and take like that. For the current production, always assume the 100%. This is how it works. Okay, the rest process is the same, except that in terms of materials, I should not add this line over here. I will not add this line over here. Instead, when I'll calculate the value of units completed, I'll write the opening cost over here. I'll write the opening cost over here and then try to calculate that. Okay, so that is the sequence. I'll suggest you, students, if possible, do solve one problem based on units completed using FIFO. And if there are any difficulties, please let me know. Okay, but I've told you the process. I'll make a breakup first. See the changes. I'll make a breakup. The second change, in cost per equivalent unit, I'll not write the opening stock. That is the second change. Third change, when I'll calculate the units completed, I'll add the opening cost over here, only in units completed. I'll add the opening cost and then transfer to the next process. So there are these three changes if you are following FIFO. Okay, I'm repeating the changes again. First, when you are making the table, make a breakup. How much from opening, how much from current. Second, when you are making this cost per EU, cost per equivalent unit, don't add opening stocks. Third change, when you are calculating the value of units completed, in this one, add the opening stocks. Done. Okay, these are the three changes which you do when you are solving with the help of FIFO. Third, in exam, which method to be followed? This is the query I've got. So, beta, in exam, which method you have to follow will be specified by the question itself. Like in this particular question, what we did, they have clearly told you, you are required to prepare using average method. Are you getting the point? So the question will always specify which method you have to follow. Okay, the question will always specify that. See the previous question. Presuming the average method of inventory is used. See the previous question. Using the FIFO method. Like that. Okay. So always they will specify which method you have to follow while doing the problem. Everybody, you are clear with the entire process? Are you clear with the entire process? So this is a big part over here. Okay, that's why we are spending so much time, because there are so many concepts over here, right? We must go in depth. All of you have understood it thoroughly now, how you have to make the statement of equivalent production, and how to calculate the cost per equivalent unit, and then how to calculate the finished stocks and everything. The question which we did, let us just check the solution of that if we can do. This was the question, right, which we did, fourth one. The fourth one. Let us see the answer. If it is really the way we have done this. See this? Isn't it the same? The statement of equivalent production completed 35, 100, 100%. There's no opening breakup. Normal loss dash 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 dash. Abnormal losses 100%, 80%. Closing 180. Then the same thing what we did. Opening stocks, cost incurred for the month less realizable value of scrap. You get the total cost, divide by the equivalent units, so you get the cost per EU. Then how to distribute the cost? I have calculated the cost for everything, right? Units completed, 35,000 units into like material, labor, overheads. For abnormal loss, material, labor, overheads. For closing WIP, material, labor, overheads. Their quantities which are given in the above table, and then just simply keep on multiplying and get the values. This is how we do. It's very simple, but the problem, it is lengthy. Okay, It is lengthy. Remember that it is simple, but it is lengthy. You are going to, make at least 3 to 4 charts in this. It is going to be lengthy. There is no doubt about it. But if you understand the sequence, it is very simple. It is very simple actually. Next, students, this chapter is actually having one more concept, and that is interprocess profits. We wanted to see the previous question also, which we solved in the class. Okay, so this was correct. You remember this process 1 and process 2 which we made, this one? His answers were correct. Our answers were absolutely perfect. Abnormal gains and all that, they were perfect. We haven't checked that actually that time. Okay, okay, let's move ahead. Now, the last concept of this chapter is interprocess profits. Now, what are interprocess profits? Basically, one process is transferring goods to the other process, but they are adding some profits also. Remember that. Now, this is not a simple concept at all. Okay, remember that this is not a simple concept. Okay, so I'll explain you in brief how exactly it is to be done. Interprocess profits, okay, there's only one question given over there. First of all, there's only one question. I'll explain you the question, how it is to be solved. See this question, A Limited produces AXE. So if it comes in your exam, this is the only question that is going to come in your exam. The amounts will change slightly, but that's it. This is the only thing that is going to come in the exam. Now there are process 1, process 2 and finished stock. Output of process 1 is transferred to process 2 at a profit of 25% on the transfer price. That is 25% of the sale price. Transfer price is sale price. So 25% of transfer price is basically, it's like 1/4 of the selling price is actually 1/3 of the cost price. So 33.33% of the cost price. Remember that. Output of process 2 is transferred to finished stock at 20% profit on the transfer price. So 20% of the sale price is 25% of the cost price. Stock is valued at the prime cost. Finished stock is valued at the price at which it is received from process 2. Sales during the period are also given. Now, students, we have to make some accounts, process 1, process 2, and like that. So whenever there are profits that are added, actually inter profits if that are added, you have to make some columns. What are the columns you have to make? Particulars, cost, profit, total. Okay, remember the sequence: cost, profit, total. Okay, simple. So in the cost column, I'll write all this: opening, material, wages, overheads, right? In the cost, it will be everything. See this. In the cost, I've written everything. Okay. Now, sir, why are we totaling prime cost over here? See this. Opening stock is there, material is there, wages is there. We have got prime cost. Sir, why we are totaling the prime cost? Because they have given stocks and processes are valued at the prime cost. So we have to measure the prime cost. That is why. Okay. So what I'll do is, I'll measure the prime cost. I'll add the overheads. Overheads are straight away given in the question. You can see that overheads are straight away given in the question. Closing stocks obviously written on the credit side. Okay. Now I'll balance this. I'll get how much is the cost that is transferred to the next process. How much is the profit that is going to be levied. Okay. Profit obviously बात है हमने already calculate कर लिया. 25% of the transfer price is 1/3 of the cost price. So the cost was 40,500. So 1/3 of that 13,500. Take the total is 54,000 which will be transferred. Okay, so I have balanced the columns of cost. And after balancing, I found that 40,500 is getting transferred to the next process. So 1/3 I took, I got the profit, and after adding this, I got the total. This is how it has to be done. Okay, this is how it has to be done. Now, the challenge was not in the first one. The challenge is actually in the process 2 account. Why process 2? Because he has given you 2 extra information for process 2. Inter-process profits included in opening stock. This is also given. Okay, inter-process profits included in the opening stock. There are already some opening stocks which are having the profits. Sir, the previous opening stock, why it was not having the profit? Because this opening stock was purchased from outside. But for process 2, whatever the opening stock is there is have come from process 1, and process 1 always transfers with profits. So that is why there are some unrealized profits which are there in the opening stocks. Okay. Now what you have to do is, when you will write the opening stocks, to balance brought down. Okay. That time, see this, to balance brought down. That time you have to write the cost as well as the profit. Now Whatever I have transferred from the first process will be returned to the second process. Now, some new materials, some new wages, I got the new prime cost, I got the overheads. Okay, till here also it is easy. Now, the challenge, where will be the challenge? They have given you the closing stock as 4,500. Students, if the opening stock is having some profit, the closing stock will also have some profit. This 4,500 will also have some profit, right? If the opening stock is having this profit, the closing stock must have also some profit. Sir, then what will be the profit included in the closing stock? Now, this is where the challenge is. I know that the selling price is 4,500. I want the profit from this figure. So what I do is check the solution. The prime cost was 90,000, out of which the cost is 75 and the profit is 15,000. Cost is 75 and the profit is 15,000. So it means that of the prime cost, of the prime cost, 1/6 is the profit and the remaining 5/6 is the cost. Similarly, for 4,500, 1/6, 750 will be the profit and remaining amount will be the cost. This is how you have to actually solve that. This is how you have to solve that. And after doing this, we can easily balance and get the finished stock and everything. Okay, so that is the sequence we have to follow. This is not easy. I'm telling you, this is not easy, but I've tried to tell you already the important steps. The process one is actually very easy. You just write the expenses. There's no profit in the opening and all that. So just write the expenses, deduct the closing stocks, and then you will get the how much stock cost is to be transferred. Then add the profit, that is 13,500, and you'll get the total, that is 54,000. Okay, so you'll get all the columns. But in process 2, already where opening cost is coming with profits, we have already transferred 54,000 with 13,500 profit. Now we get the prime cost, that is 90, which is having 75,000 as the cost and 15,000 as the profit. So 1/6 is the profit and 4/5 is 5/6 is the cost. So similarly, I have balanced the closing stock, and out of 4,500, 750 will be my profit. So this is what I should understand. Okay, and after getting this, you just balance all the other columns, you'll get everything because the profit margins and all that is given. So not a problem. The same way, you will actually balance the cost column first, you will get the cost column, you will add the profit. Okay, so you got the profit, then you get the total and all that. Okay, so that's the sequence will follow, and same will be done in the finished stock account. So that is how we have to do this question. Okay, so this one is not easy, you will have to practice a bit in this one. This is all from the chapter process and operations costing. Okay, now we'll move to the next one, that is joint and byproducts costing, which is again a very easy topic. Process was a bit difficult, but joint and byproducts costing is quite easy. I'll tell you one thing, joint and byproducts normally do not come in every exam, at least for the practical stuff. Okay, in practical, it will not be asked in each and every exam. Sometimes it is asked in theory and like that. Uh, Joint products and byproducts. Joint products and byproducts. Students, are you all clear with the chapter process costing? Are you all clear with the process costing? Shall we move ahead with the joint products and byproducts? Come on, जो है बेटा यहाँ पे एक बार डन भेज दीजिए. Done, yes. Reply anything. Come on. Show me at least you are there. Okay. So we'll start with the next one then. The first one what we took today was my process one, which was obviously a big one only. Okay. Now the next one is a very small topic, is a very simple topic, that is joint products and byproducts costing. Okay. Now joint products and byproducts. Okay. Chalo, thank you so much. Thank you so much. श्रेया कीर्ति सिद्धेश आर्य अभिजीत अविशा श्रीरक्षा अविशा आर्य अभिजीत श्रेया सिद्धेश भरत श्रीरक्षा अग्नि संहिता वैष्णवी. चलो, all of you are there. Great, 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 great. And all others keep interacting. Okay. Now, students, let's move to the next one, that is joint products and byproducts costing. Okay, this we have already done this entire thing. Okay, as you can see over here, we have already mentioned like WIP is calculated only for FIFO method. Okay, under average, we don't break it up and all that. Now, interprocess profits and all that is done. Operation costing is nothing actually. Operation costing is basically when you are producing different, like suppose if there is a car manufacturer. Okay, so they are making different variants, like like if I talk about Honda City, there will be Honda City ZX, VX, like that. So different models, but the process is more or less the same. Now coming to the joint products and byproducts costing. So joint products are something which are actually getting manufactured together. Okay, both of them are significant products. Okay, so they are joint products. What are byproducts? When two or more products are actually made together, but one of them is very significant as compared to the others, and others are actually having a negligible value, then that is byproducts actually. So byproducts are actually end of materials discarded from the process. Okay, while joint products are, they are not discarded as such, they are all actually the main products. Now see this crude oil thing. You can see this. If I add the crude oil in the refining process, I'm going to get petroleum gas, gasoline, kerosene, diesel, industrial fuel oil, lubricants, and all that. So I get so many things with the help of this crude oil. Okay, I get so many things like this. Okay, so after doing all this, understand these are all equivalent products. Like petroleum gas is also important, gasoline is important, kerosene, diesel, industrial oil. They are all having equal weightage. They are all having a good demand in the market. So they are all actually joint products. They are all having commandable value. They are all what? Joint products. Now, students, understand, since they are all joint products, are all joint products. Similarly, when we are producing this sugar, okay, when we are producing sugar, what happens is after all that evaporation, crystallization, okay, you get two things. One is sugar and one is the discarded material, that is the molasses. That is byproduct, okay, because that is not having that great value. Okay, that's not great value. So molasses is considered as a byproduct. And remember, for byproducts, there's a general tendency, there's a general method. For byproducts, what you have to do is you just have to calculate its NRV and reduce it from the cost of the production. That's it. Byproducts have to be measured at their NRVs and reduced from the cost of the production. Now, the point at which these items get segregated, the point means this process where they are actually getting segregated. Petroleum is getting different, gasoline is getting different, kerosene is getting different, like that. The process, the point where these are getting segregated, that point is called as the split off point. Now, what is the problem in this chapter is after split off, each product will have their own expenses. Petroleum refining different, gasoline filtration different, like that. So each product will have their different expenses after split off. But before split off, pre-separation if I talk about, तो प्री सेपरेशन बोलिए या ज्वाइंट कॉस्ट का खर्चा बोलिए, ये प्री सेपरेशन का जितना भी खर्चा है, दैट इज ऑल ज्वाइंट, and you have to divide this joint cost over all the products. So I have to divide, understand, I have to divide the cost of this over all this petroleum, gasoline, kerosene, diesel, industrial fuel. I have to divide it amongst all of them. So this is the challenge. On what basis will I distribute the cost of the crude oil over to all this crude oil as well as the refining charges? Okay, now once we are doing this, there are many methods of doing this. See this. First is physical units method. Second is NRV at split off. Third is technical estimates. Fourth is market value of point of separation. Fifth is market value after further processing. Sixth is average unit cost method. And seventh is the contribution margin method. So these are the 7 methods which are used to apportion the joint cost over the various products. Okay, these are the 7 methods which are used to apportion the joint cost to various products. Now, students, we will be taking up one by one each and every one of them. Okay, these are very easy. Okay, now students, the first method is the physical unit method. See this question. Okay, now we'll be quickly discussing how to solve this because these are very easy. A coke manufacturing company produces the following products by using 5,000 tons of coal at 1100 per ton into common process. Okay, so what is the joint cost? 5,000 tons at 1100 per ton. Come on, multiply. So 5,000 into 1100, the joint cost is 55 lakhs. Coke is being produced 3,500 tons, tar 1,200, sulfate 52, benzol 48. I want to apportion this using the physical unit method. If I take the total of all this, the physical quantities which are produced, if I take the total of all this, the physical quantities are produced is 4,800. If I take the total, 4,008 tons. Now, I want to calculate for coal, for coke, how much to apportion. So 55 lakhs for 48 tons, 48,000 tons. So 55 lakh divided by 4,800, multiply by 3,500 tons. So that is coming 4010416.6666 like that. Okay, so that is how I'll apportion this cost. That is how I'll apportion this cost. Now students, do one thing, do calculate for tar. To calculate for tar. Okay, this 55 lakh, which is the common expenditure that is being done for 4,800 tons. So 55 lakh divided by 4,800 tons, multiply this by 1,200 tons and tell me how much is the cost of tar. You can round it off the figure. You can round it off. You can round it off. Come on. Well, I'm waiting for your answers. So Shiraksha, Samitha, Shreya, your answers are correct. That is 13,75,000. That is 13,75,000. It is absolutely perfect. Okay, you will simply divide this 55 lakh divided by 4,800, multiply by 1,200. This is how it works. Okay, Avisha, Vaishnavi, everybody, your answers are correct. Okay, Chali, 13,75,000 is right for Coke. So this is how we do. The next method is NRV at the split off point method. Now, how you do this NRV at split off point method? So understand this. NRV at split off, basically what you do is take the sell price. Okay, take the sell price, and from the sell price reduce the estimated profit margins, reduce the selling expenses, and if there are any post split off costs, reduce that. So after, from the sales, if I reduce all this, what will happen is, from the sales, if I reduce all this, what will happen is, actually I'll get, understand, I'll get a kind of NRV at the split off point, and then the entire joint cost will be distributed in the ratio of this NRV. Okay, so remember this, from sales value of the final product. Okay, from sales value of the final product, remove the profit margin, remove the selling expenses, remove the post split off cost, you get the NRV at split off. And when once you get the NRV as split off, joint cost will be distributed in that ratio. See this: sale units, sale value of the final output, less profit margin, less selling and distribution, less post split off cost, get the NRVs. Okay, now see this example: an entity incurs a joint expenditure. Uh, An entity incurs a joint cost of 64,500 in producing two products, A 200 units, B 200 units, earns a sales revenue of 86,000. So there is a joint cost. They are earning sales revenue of 86,000 by selling 170 at by selling at 170 per unit of A and 260 at per unit of B. So 200 units into 170, I get the total sales value 34,000. 200 units, 260, 52,000. I got the sales value. From the sales value, I have to reduce the further processing cost. Okay, see this, I have reduced the 4,000 and 32,000, which is the further processing cost. So from sales, further processing cost nikal lijiye, you will get the NRV at split off 30-20. In this ratio 3:2 divide 64,500. तो joint cost जो है वो NRV at split off पे बटेगा. ठीक है, so this 64,500 will be distributed in the ratio 3:2. Okay, so and you will get this figures now: 38,700, 25,800. सिंपल. सेल्स वैल्यू देखिए फाइनल प्रोडक्ट का, उसमें से पोस्ट स्प्लिट ऑफ खर्चे माइनस करिए, गेट द एनआरवीज, और इन दिस एनआरवीज डिवाइड द जॉइंट कॉस्ट. एवरीबॉडी क्लियर? एवरीबॉडी क्लियर? The third method is actually technical estimate, which is not actually only a method. Technical estimate क्या होता है, तो आपको सीधा सीधा ये बता देगा कि किसका किसका कितना कितना खर्चा होगा, like 10% for this, 20% for this, like that. वो ऑलरेडी आपको क्वेश्चन ही बता देगा. Big lag. Okay. Okay. If you have any difficulty, please ask. If you have any difficulty, please ask. Now, the next method is market value at the point of separation. It's a very simple method. Market values at the point of separation. Now, see this question. It actually उसके नाम में ही दिया है बेटा. Market value at point of separation. What does it mean? Point of separation पे जो market value है उस ratio में बांट दीजिए. Simple. See this. An entity incurs a joint cost of 64,500 in producing two products. A 200, B 200, earns a sales revenue of 86 by selling at 170 per unit of A and product B at 260 per unit. Okay. Now, so what happens is, see this, I'm incurring this joint cost. This is the point of separation. Okay. We are getting two products and this is their sell price. So 200 into 170. तो पहले वाले का ए का सेल प्राइस कितना होगा 34,000, राइट. 200 इंटू 170 34,000. 200 इंटू 260 बी का कितना हो गया 52,000. So these are the sell price at the point of separation. Now this method tells you whatever is the market value at the point of separation, the joint cost will be distributed in this ratio. So 64,500 I have to divide in this ratio. Students, calculate now what will be the amount allocable to job product A. If these are the market values at the point of split off and I have to divide the 64,500 in this ratio, calculate the cost allocable to A. The total of this comes actually 86,000. Come on, everybody calculate the cost which is allocable to product A. Out of 86,000, 34,000 belongs to A. So out of the total cost of 64,500, how much will belong to A? How much will belong to A? I have tried to cross multiply that. Out of 86,000, 34,000 is of A. Sanmitha, Sriraksha, Shreya, your answers are correct. Okay, so out of 86 amount, like 84 belongs to A. So out of 64,500, how much will belong to A? That is 25,500. 25,500. Absolutely perfect, student. Arya, Abhijit, Shikha, Samita, Siddhesh, Vaishnavi, your answers are correct. 25,500. Okay, so I hope you have understood how you have to allocate at the market value on the point of separation, which is very simple method. This is a market value at the point of separation. Similarly, the next method can be market value after further processing. Now what you have to do is, like, after further processing, whatever is the market value, divide it in that ratio. Very simple. After processing, whatever is the market value, divide it in that ratio. So like, for example, if A and B can be further processed and after further processing the market values are 200 and 300, like this A and B, which if we use without processing, the rates are 170 and 200. If we process it further, the rates are 200 and 300. The rates are 200 and 300. Now can you tell me what will be the distribution of the cost of 64,500 after further processing? Okay, what will be the distribution of 64,500 in A and B if I use the market value after further processing? So what will happen is, market value after further processing for A and B, 200 units at 200, so that will be 40,000. Similarly, 200 units at 300, that will be 60,000. Total 1 lakh. Okay, so for the total of 1 lakh, 40,000 is of A, 40% is of A. So if the joint cost is 64,500, so 64,500, so 40% will belong to A. 64,500 into 40%, so 25,800 will belong to A, like that. So what we are doing in this one is we are taking the cell values after the split off. Okay, we are actually we are taking the market rates after further processing. Okay, so this is how we are trying to do this. It's a very simple thing. It's a very simple question. In fact, market value after further processing. Perfect, Samita. The next method is average unit cost method. One of the easiest methods, kind of you can say physical quantity method, very similar like that. Okay, it's very similar to the physical units method. See this question, you can easily do that. There's nothing for me to explain in this. You can easily do. Pre-separation cost is 60,000. I have produced 500 units of A, 200 units of B, 300 units of C. In all, I have produced 1000 units. Can you tell me what will be the cost for A? Simple. Out of 1000 units, 500 units are of A. Like 50% units are of A. What I'll do is 60,000 divided by 1000 units produced. So I get 60 rupees per unit. So this is unit cost method. Okay, this is average cost method. So 60 rupees per unit. I have produced 500 units for A. 500 into 60. So 30,000 will go to A. Similarly, 200 units of B. So 200 into 60, 12,000 for B, like that. Okay, so what will happen is my per unit cost is going to be the same. Remember that my per unit cost will be same 60, 60, 60 for A, B and C. I simply divide the total cost by the total quantities, total units which I have got produced. Okay, very simple. It's very simple. Next method is actually contribution margin method. Now this is something which relates to the marginal costing chapter, of course. Okay, contribution margin method, what you do is from the total sales reduce the variable cost. Okay, from the sales reduce the variable cost, maybe in terms of physical quantity or in some other ratio, but reduce the variable cost from the total cost, total sales, sorry. So from sales, if I reduce the variable cost, I'll get contributions. Then whatever is the joint cost, divide this joint cost in the ratio of the contribution margins. Okay, I'll repeat the process again. So what I'm going to do is I'll take the sales value of products. Suppose X and Y, there are two products. I'll take their sales values. Okay. After sales value, I'll reduce the variable cost. Now, sir, variable cost, how will it be distributed? Either it will be given separately. If they don't give you separately, then distribute it in terms of quantity or something like that. I'll get the contribution. I'll get the contribution. And whatever is the joint fixed cost, distribute in the ratio of the contribution. Whatever is the joint fixed cost, distribute it in the ratio of the contribution. So this is contribution margin method. Okay, this is contribution margin method, which is actually a very simple method. So X and Y is the sales. Okay, X and Y, take the sales for that, reduce the variable cost, you get the contributions. Whatever the contributions, distribute the joint fixed cost in the ratio of those contribution margins. Students, can you solve for this question? Come on, let's go for it. Let's do this. Come on. Write on the sales for A and B. Marginal cost, basically marginal means variable cost. Distribute it in the ratio of quantity. Get the contributions. Divide the fixed cost in the ratio of contributions. And tell me what is the fixed cost for A, what is the fixed cost for B. Come on. Divide it in the ratio of contributions. Come on. So I'm waiting for your answers. This is the last method. Okay, this is the last method. It's very simple. Nothing much actually. This chapter is very small and very easy actually. Come on, students, do calculate fast. Come on, do calculate. Write down the sales less variable cost in the ratio of quantities. Okay, so this 4400 divided in the ratio 100 is 100 kgs to 120 kg. And after that, you will get the contributions and divide this fixed cost in the ratio of the contributions. A, B, sales 100 into 60, I guess 60,000. 120 into 30, that is 36,000. Less marginal cost, basically 4400 in the ratio of the kgs. 100 is to 120. Okay. So if I have to divide this 4400 in 100 is to 120, 4400 into 100 upon, I guess, 1220. So 4400 into 100 divided by 220. So that is 2000 for A and 2200 for 2400 for B. 2000 for A and 2400 for B. I'll get the contributions. I'll get the contributions. So 60,000 minus 2,000, so that is 58,000. 36,000 minus 2,400, I get 33,600. Now, whatever is the fixed cost, 3,900, you have to divide it in the ratio of 58,000 is 33,600. What is the total, by the way? 8,000 plus 33,600 is 91,600. Okay. I think some error is there, I feel, right? Fixed cost is 3958. Let me check. 100 into 6, is it 6? Oh, it is 6,000, not 60,000. I just written the wrong figures. Okay, so there is 6,000. So it will be, I guess, 4,000. And this will be then, similarly, this will be 3,600 then, right? Yeah, 3,600. So that will be 1,200. So I'll divide it in the ratio 50 to 100. So 3,900 into 4,000 divided by 5,200. So that is 3,000 for this, 3,000 for this, and 900 for this. Yeah. Everybody, your answers are correct. Okay, your answers are correct. Your answers are correct, student. By mistake, I made a typing mistake. Actually, I assumed 110 extra. That is why my answer was coming different. So you've got the answers. That's good, right? You've got the answers. Everybody, perfect, perfect. Let's move ahead then. So this was the last technique. Actually, I think the network was disconnected for a bit. Okay, so see, in practical life, the byproducts are actually measured at the net realizable values and reduced from the total cost of production. But in academics, actually, there are 2-3 methods suggested for that. One is you can reduce what we have already discussed. Second thing is what you can do is you can calculate the cost of byproducts and keep it aside. Okay, what you have to do is you will have to measure them at their standard cost. Okay, you will have to measure them at their standard cost. So this can be done with if you are doing a standard costing. If you are doing the standard costing. Next is you can measure the byproducts at a value which is comparative. Now, what is comparative over here? Basically, for example, whatever the byproduct is getting out, I'm having a same material in the market also. Okay, so in market, if it is trading at 20 rupees a kg, And I'll measure my product. My product are also 20 rupees per kg, like that. Similarly, reuse basis method. Suppose if the byproducts which I'm making, suppose that the byproducts we are making, if we actually use it somewhere else, okay, if we use it, then whatever is the cost of the new material has to be taken, okay, as the measure, as the value of this byproduct. Next, if the amount is very small, we can create, now to seeing the treatment, if the amount is very small, we can credit it to costing P&L. We can also transfer it to other income. We can show it as a deduction from the total cost. This is the most followed method. And if the amount is quite large for byproducts, we may think of considering as a joint product itself. Okay, we may think as considering as it as a joint product itself. So this is more or less the treatment. In general, what you have to remember is, if there is a byproduct, its NRV has to be reduced from the cost of production. Simple. I've got a query, sir. Is it okay if we skip this chapter completely? Yeah, can do that, but that's an easy chapter actually. We don't need to actually skip this chapter, to be very frank. Okay, so I'll be taking up this one question. Okay, this one question is more or less everything now. बस ये एक ही करने का अपने को हो गया बेटा इस chapter फिर. Inorganic chemical purchases salts and processes into more refined products such as caustic soda, chlorine, and PVC. In the month of July, inorganic chemicals purchased salt for 40,000. Conversion cost of 60,000 were incurred up to the split off point, at which point two sellable units were produced. So, how much is the joint cost? We have purchased some salt for 40 and conversion cost of 60. We have done to split them off. So, there is a total cost of 1 lakh. So we have got two sellable products, okay, and that is caustic soda, I guess, and chlorine. Chlorine can be further processed into PVC. So chlorine can go into PVC. Next, all 800 tons of chlorine were further processed at an incremental cost of 20,000 to yield 500 tons of PVC. Means this chlorine is further processed after spending 20,000 to yield 500 tons of PVC. There was no beginning or ending inventories of caustic soda, chlorine, or PVC in July. There is active market for chlorine. Inorganic chemicals could have sold all of its July production of chlorine at 75 rupees per ton. So we could have sold this. What is the sellable price for this? That is 75 rupees per ton. Okay, remember that. Show how the joint cost of 1 lakh would be apportioned between the caustic soda and chlorine under each of the following methods. First is sales value at split off. So if I have to segregate this 1 lakh into sales value at split off, how I'm going to do that? It's very simple. Sales value of caustic soda 1200 quantity into 50 will be 60,000, and sales value of chlorine at the split off point 800 into 75, that is also 60,000. So these are equal. So the joint cost will also be distributed equally. Okay, so 50,000 for caustic soda, 50,000 for chlorine. This is how it will be distributed. Students, is it clear? The first process, is it clear? The sales value at split off. I have calculated the sales value at this point. I have calculated the sales value for chlorine 60 equal. Okay, so the joint cost of 1 lakh will also be divided equally. Is this clear? Clearly. So almost all of you are saying yes. Okay, that was actually very easy. The second method he has suggested is physical unit method. So if I have to divide this 1 lakh in physical units method, now what will happen? What are the physical units? It's very simple. The physical units are 1200 and 800, right? The physical units are what? 1200 tons and 800 tons, right? So 1200 and 800. So basically the ratio is what? They are all multiples of 200, right? So that will be 6 is to 4. In fact, I can say they are multiples of 400, I feel. So this will be 3 is to 2, right? 3 is to 2. So divide this 1 lakh in the ratio 3 is to 2 in the ratio of their quantities. So it will be 60,000 for A and 40,000 for B. Is this method clear now? Means 60,000 for caustic soda and 40,000 for chlorine. Okay, so dividing it in their physical units. Is it clear? The next method is estimated net realizable value method. Now I know estimated net realizable value method, what actually does is it calculates the NRV after the split off. Okay, it calculates the NRV after the split off. Okay, I'll solve this one. Okay, I'll solve this one. So what will happen is, we all know that chlorine, I want the NRV. Now how to do the NRV? Sales value of the finished product. So finished product is 500 tons of PVC. We have already been given that all 800 tons were further processed and to yield 500 tons of PVC. Okay, so 500 tons of PVC, the selling price is 200 rupees per ton. So chlorine cum PVC and caustic soda. Caustic soda. What is the sales value now? See, caustic soda, the sales value is what? 1200 into 50, right? 1200 into 50, the sale price is 60,000. For chlorine, I have made 500 quantity for selling price of 200, so that is 1 lakh. Less further cost, less further processing cost. So 20,000 is given for this. So how much is the NRV? 80,000 and 60,000. The NRVs are 80,000 and 60,000. Now dividing this 1 lakh joint cost in this ratio, 60 is to 80, 3 is to 4. Come on. So 1 lakh divided by 7 into 3. So 42,857, 57,143. So this is how the joint cost will be distributed, okay, in the ratio of their net realizable value. In the ratio of their net realizable value. Okay, so this is the first part of the question, dividing the joint cost among the two products. Any doubts till now? Any doubts, beta, till now? The third method, we have already done, right? So lifetime swimming pool. Now the last part of the question. Lifetime swimming pool products offers to purchase 800 tons of chlorine in August at 75 per ton. Means they are trying to ask you that if we purchase this 800 tons at 75 rupees per ton, the sale would mean no PVC would be produced. So I'll not be able to produce this. Explain how the acceptance of this offer would affect our operating income. So how will this affect our operating incomes? It is simple as that. We all know, like if I produce this, like if I am already getting my 800 tons of chlorine, which we can sell at 75. So if I sell it at 75, if I sell it at 75, I get how much? I get 60,000 rupees. I get how much? 60,000 rupees I get. Now, suppose if I produce PVC, I get 500 tons which can sell at 200. So I get an earning of 1 lakh. But for doing this, I must spend 20,000 on the further processing. I must spend 20,000 on the further processing. Okay. Then only I can sell the PVC. So 500 into 200, 1 lakh is what I will receive after spending 20,000. So net earnings from PVC is 80,000. However, net earnings from chlorine is only 60,000. So if I accept the offer for producing for selling the chlorine, then I will make a loss of 20,000 rupees. My operating income will get reduced by 20,000 rupees. Okay, now is this clear? If I directly sell chlorine, I get an earning of 60,000. If I produce this PVC, what happens is I get an earning of 1 lakh, but for doing this, I need to make a further processing expenditure of 20,000. So I get net 80,000 only in hand. So if I sell chlorine, I get 60 in hand. If I make PVC, I get net 80 in my hand. So I will make a loss of 20,000 rupees. My operating income will reduce by 20,000 rupees in case I do not produce PVC. In case I directly sell off my chlorine. So this is all from this chapter. I hope everything is clear. Okay, and now we'll be moving to the last chapter for today, which is marginal costing. Okay, so today I thought we'll be taking a very important chapter, and that was marginal costing, students. Students, come to the topic marginal costing. This is all we have already done, joint cost and byproducts and everything. We'll finally start with the next chapter and the last chapter, that is marginal costing. Okay, so marginal costing, students, kind of I can say a variable cost costing. Marginal cost are nothing but the variable cost. Why so? The marginal cost is basically the cost for producing one extra unit, but the fixed cost do not change. Only the cost which will change for producing an extra unit is the variable cost. So marginal costing actually tells you about the variable cost only. Okay, now there are many terms over here. Marginal cost is basically the cost for producing an extra unit. And then you have the marginal costing is basically where you will account for those costs. Okay, where all the variable costs, they will form part of the cost of production, and all the fixed costs will directly go to the costing P&L account. Direct and marginal are the same more or less. Okay, and differential is basically where your production level increases sharply, level increases sharply. Okay, like for example, suppose you are producing 10,000 units, now all of a sudden you are started producing 12,000 units. So the total difference of the cost is called as the differential cost. Now see this under marginal costing, this is the cost and profit statement which is normally made. We take the revenue, we take the entire revenue, which is the entire sales, less all the direct expenses, direct manufacturing expenses, direct material, direct labor, direct expenses, variable manufacturing overheads, only variable, okay, not the fixed one. We get the product or inventoriable cost. Okay, we'll get the product inventoriable cost. Next, after reducing this product or inventoriable cost, basically after reducing the product cost from the sales, I get the product contribution margin. From this product contribution margin, I have to reduce the remaining two variable overheads, that's the variable administration, variable selling overheads. If I reduce this, I'll get the contribution margin. So what happens is from sales, first reduce four items: direct material, direct labor, direct expenses, and variable manufacturing overheads. You get the basically, first of all, you are reducing the product cost. You are reducing this four means you are reducing the product cost. So from sales, if I reduce the product cost, I'll get the product margin. From product margin, reduce the other variable cost like variable overhead, administration, variable selling and distribution overhead. You get the contribution margin. Now from contribution margin, reduce all fixed expenses, maybe manufacturing, maybe selling, distribution, reduce all the fixed expenses, you get the profit loss. Okay, so this is what is there in this one. This is how we make this statement. Now in this one, we have to make up a analysis which is called as the cost volume profit analysis. Now, this cost volume profit analysis is actually basically analysis in terms of three things. One is cost, one is selling price, and third is the volume. Okay, so basically cost, volume, profit. In fact, I can say cost, quantity, and the profits. Okay, these three things are related in this one chart, in this one analysis. There's a CVP analysis. What will happen if I increase the volume a bit? Okay, what will happen if I increase the volume? How much will my cost get affected? How much will my profit will get affected? Because selling price per unit will be the same. Okay, so CVP analysis try to measure like how much will be the change if you change the just the quantity by 1 unit. Okay, that is being done by the CVP analysis. Now you have to see there's a marginal cost statement which we have actually already made above, but the above one was a proper entire format of P&L. Okay, but normally if you have to do for small problems, you'll follow this one. Sales less variable cost gives you contribution, less fixed cost gives you profit. Now students, there are a lot of formulas in this chapter, as you already know. Okay, there are a lot of formulas in this chapter. The first formula will be for contribution. Now contribution, sir, what is contribution? Contribution is kind of a margin from each and every product what we get. Okay, contribution is basically excess of the sale price over the variable cost. Okay, like for example, I'm producing a new unit at a variable cost of 60 rupees and I'm selling this product at, let's say, 100 rupees. So variable cost is 60 rupees and I'm selling it at 100 rupees. It means that I'm recovering 40 rupees extra. And this 40 rupees extra will be what I'm recovering, okay, will contribute towards my fixed expenses and my profit. This 40 rupees will help me to recover all my fixed expenses and this 40 rupees will help me to generate profits. Okay, so remember that whenever I have to pick, manufacture a new unit, my fixed cost is already done, right? So I have to manufacture a new unit. So all I have to incur is the variable cost. If my variable cost is 40 rupees and 60 rupees and my sell price is 100 rupees, so I'm generating an extra contribution of 40 rupees. This extra contribution is actually helping me to pay off my fixed expense bills and to generate my profits. Okay, so this 40 rupees surplus is actually contributing towards my fixed expenses and my profits. Okay, now, so contribution, the formula is sales minus variable cost gives you the contribution. So contribution is actually covering two things, fixed expenses and profits. So the first formula what you should understand is sales minus variable cost gives you contribution. Fixed expenses plus profit, that is also contribution. You can reverse the formulas. So I can write like this, sales minus contribution will give me variable cost, or I can also write contribution plus variable cost is sales. Okay. Similarly, contribution minus fixed expenses will give me profit, like that. I can do interchange and all that. Now students, the next concept is of the PV ratio or the profit volume ratio. Now this PV ratio or the profit volume ratio, what we are talking about, understand there are 5 different formulas for PV ratio. This ratio is very similar to the gross profit ratio or the net profit ratio, which we normally use in our accounts or costing. This PV ratio determines out of sales of 100 rupees, what amount of contribution you are generating from the product. Like for example, I'm selling my products at 100 rupees, okay, and my PV ratio is 30%. Sell price is what? 100 rupees and PV ratio is what? 30%. So if out of the sell price of 100, if the PV ratio is 30%, it implies that your contribution is 30 rupees from the 100 rupees of sales. Okay, your contribution is 30 rupees in 100 rupees of sales. So, sir, how much will be variable cost then? Out of 100 rupees, my contribution is equal to sell price into PV. So basically that is 100 into 30%. So that is 30 rupees. That is 30 rupees. So how much is my variable cost? I know, see, if PV ratio is 70%, variable cost ratio is equal to 70%. Okay, 100% minus PV ratio will give me the variable cost ratio. So out of 100, 30% or 30 rupees is the contribution. So 70% is the variable cost. So 70 rupees is my variable cost. Okay, this is how I can, keep on interchanging them. Now, what are the different formulas for PV ratio? So the different formulas for PV ratio are like this. First formula for PV, contribution upon sales into 100. The second formula, change in contribution upon change in sales into 100. The third formula, change in profit upon change in sales into 100. Fourth, contribution per unit upon selling price per unit or sales per unit into 100. Last, PV ratio 100% minus variable cost ratio, PV ratio. So these are the 5 different formulas to calculate the profit volume ratio. Contribution upon sales into 100, change in contribution upon change in sales into 100, change in profit upon change in sales into 100, contribution per unit upon selling price per unit into 100, or 100% minus variable cost ratio gives me the PV ratio. PV ratio denotes that out of sales how much is the contribution. So students, let me ask you one very simple question. If I'm making a sales of 5 lakh and my PV ratio is, let's say, 40%, can you tell me how much is the contribution I'm making? How much is the contribution that I'm making? How much is the contribution that I'm making? Remember, I want to calculate the contribution. So PV is equal to contribution upon sales into 100. I want the contribution. I'm having the PV ratio. I'm having the sales. Just multiply this. Sales into PV ratio gives you the contribution. So Sanmita, your answer is correct. Siddesh, please check again. Arya, Shikha, Abhijit, Avni, Samitha, Sujan, Shreya, Bhavya, your answers are correct. Remember, sales into PV ratio directly gives you the contribution. Okay. So 5 lakh into 40%, that is 2 lakh. Perfect. Perfect. Vaishnavi, Tanushri, perfect. Seen this formulas. Now there is this break-even analysis, but before I take this, I am going to take one particular question. Before I take that, actually, I'll have to explain you what is break-even and a point, what is margin of safety and something. See, there's one concept of break-even point. Break-even point, the formula can be in 2 things. If I talk about break-even quantity, a point, the quantity at which you will earn no profit, no loss. See, if you sell 0 units, your entire fixed cost is in vain. Okay, you are already at a loss. But if you produce some quantity, if you generate some contribution, then at break-even quantity, fixed cost upon contribution per unit, at this quantity, your profit will be 0, your loss will be 0. Fixed cost upon contribution per unit will give you the break-even quantity, a point of no profit, no loss. Similarly, if I want the number in sales, if I want the number in rupees, then the formula for break-even sales is actually fixed cost upon PV ratio. Fixed cost upon PV ratio. Okay. Fixed cost upon PV ratio. This formula actually tells you how much sales you need to make to earn basically no profit, no loss. Now, suppose students, in the previous question, okay, if I tell you my fixed cost is, let's say, 30,000 rupees, can you tell me Can you tell me how much is the break-even sales that I need to make? How much is the break-even sales I need to make if my fixed cost is 30,000 rupees? How much is the break-even sales I need to make? Obviously, fixed cost upon PV ratio. So that is 30,000 upon 40%. So that is nothing but, have you all got the answer? So break-even sales will be 75,000, right? Break-even sales will be 75,000. All of your answers are correct. Okay. Now, sir, break-even sales are 75,000 rupees. Total sales are 5 lakh rupees. What is this excess called? What is this excess called? The excess is called as margin of safety. Margin of safety means total sales minus break even sales. Okay, so 5 lakh minus 75,000, 5 lakh minus 75,000, that will give you 4 lakh 25,000 as the margin of safety sales, as the margin of safety sales. Now students, in the previous question, okay, you have already calculated this and told me, sir, if sales are 5 lakh and PV ratio is 40%, our total contribution is 2 lakh. You have already calculated that 5 lakh and 40%. So the total contribution is what? 2 lakhs. If the total contribution is 2 lakh and the fixed cost is 30,000, okay, what will be the profit? I know profit is equal to contribution minus fixed cost. So 2 lakh minus 30,000, my profit will be 1 lakh 70,000. My profit will be 1 lakh 70,000. From contribution, if I reduce the fixed cost, I get my profits. Sir, is there any other alternative to get this? Yes. The alternative to get this is the second formula for margin of safety. Margin of safety quantity is equal to profit upon contribution per unit. Margin of safety sales is equal to profit upon PV ratio. Profit upon PV ratio. So margin of safety sales will be profit upon PV ratio. Break-even sales will be fixed cost upon PV ratio. Okay. Similarly, margin of safety quantity is profit upon contribution per unit. Break-even quantity is fixed cost upon contribution per unit. Sir, in the previous question, we had already calculated margin of safety as 4,25,000. So can we directly multiply it by PV ratio and get the profit? Yes. We know margin of safety in rupees, the formula is profit upon PV ratio. Profit upon PV ratio, right? So margin of safety we have already calculated 4,25,000. So profit upon PV ratio was how much? 40%, right? PV ratio, what was that? 40%. Do one thing, calculate this. 425 into 40%. Isn't it 1,70,000, which was the same what we have calculated from the above formula also? Okay, it's exactly the same, right? It's exactly the same. So there are so many formulas to do all this. Okay, there are so many formulas to all this. So remember that. Now, students, see this now. This diagram will actually help you to understand things. Suppose if I'm trying to make the sales, okay, and the point at which the total cost and the sales line actually intersect each other, here total cost and sales are equal. So this is point of break even. Okay, this is point of break even. And if I'm actually selling this quantity, so the gap between the sales and the gap between the break even, okay, sales quantity and the break even, okay, the gap is called as the margin of safety. So to derive this margin of safety, what I can do is from the total sales, remove the break even sales, right? From the total sales, remove the break-even sales, you will get margin of safety. Similarly, from the total sales, if I reduce the margin of safety, I'll get the break-even sales. Similarly, if I add break-even sales and margin of safety, I'll get the total sales. So they all are interrelated. They are all are interrelated. Remember that. Okay, they are all interrelated. I hope you are clear with that. Okay. So total cost and sales where they intersect, I get the break even. Break even plus margin of safety total. So from total, if I reduce margin, I get break even. From total, if I reduce break even, I get the margin of safety. This is how it works. Okay, this is how it works. Now, so there are many formulas we have actually seen over here. Let me just repeat it one more time and then we can move ahead with the chapter. The first formula was PV ratio, contribution upon sales into 100. Then the second formula was change in contribution upon change in sales into 100. The third formula is change in profit upon change in sales into 100. Fourth is contribution per unit upon selling price per unit into 100. And fifth is 100% minus variable cost ratio. Then we have also seen that if I have to find the break-even sales quantity, break-even quantity, a point of no profit, no loss. The first formula for quantity is fixed cost upon contribution per unit. The second formula for sales is fixed cost upon the PV ratio. If I have to find the margin of safety quantity, the formula is profit upon contribution per unit. If I have to find the margin of safety in sales, the formula is profit upon PV ratio. Okay, so if I want in sales, if I want in rupees, I divide by PV ratios. If I want in quantities, I divide by contribution per unit. Okay, remember that to get the break even, you should compare with fixed cost. To get the margin of safeties, you get the profit. Okay, sir, can you get the profit by multiplying margin of safety quantity into contribution per unit? Yes. Sir, can I get profit by multiplying margin of safety by PV ratio? Yes. Sir, can I get the fixed cost using break-even sales and PV ratio? Yes, break-even sales into PV ratio will give me the fixed cost. So I should understand at the break-even sales, my contribution is exactly equal to my fixed cost. At the margin of safety sales, my contribution will always equal to my profit. Remember that. Break-even sales into PV ratio. So at break-even sales, my total contribution, this PV ratio will give me my contribution. At break-even sales, my total contribution will give my fixed cost. At the margin of safety, my contribution will equal to my profit, like that. Okay, so they are all interrelated and like that. And last, one more formula which you should remember is the desired sales. Is the desired sales. Suppose if the question specifies you like the fixed cost is 20,000, you should earn a profit of 70,000. How much sales you should make, like that. If this kind of questions are there, then we can use the formula for desired sales. If I want in terms of quantity, obviously I'll divide by contribution per unit. So fixed cost plus desired profit upon contribution per unit. Fixed cost plus desired profit upon contribution per unit, that is desired sales quantity. And similarly, if I want desired sales in rupees, then the formula will be fixed cost plus desired profit, what a profit you want, upon PV ratio. Upon the PV ratio. So if I divide by PV ratio, I get my desired sales, like that. Everybody clear? Let's take up a question. Students, question number 7, unsolved. Today we may extend the lecture a bit, okay, to complete this chapter. This is a big chapter and we need to solve some important problems from this. We have to cover all the topics also. So PV ratio, first of all, we want to find the PV ratio. The formula is change in profit upon change in sales. Okay, I know the formula for PV ratio, that is change in profit upon change in sales. So my profit is increasing by 5,000. Okay, my profit is increasing by 5,000 rupees and my sales are increasing by 20,000 rupees. So 5,000 upon 20,000, if I take the percentage, I'll directly get, and that will be 25%. That will be 25%, right? Fixed cost, change in profit upon change in sales. So 5,000 upon 25,000, 20,000. 5k upon 20k into 100. So I got 25%, right? I got 25%. Next, break even point. What is break even point? The formula for break even point, see, understand this. Break even point, obviously this is not in quantities because all the calculations are over here in rupees only. Students, when the profit was 8,000, okay, I've already calculated my PV ratio, that is 25%, right? 5k upon 20k. Okay, so 5 divided by 20 into 100, so that was 25%. Now, after doing this, friends, I want the break even point. When the sales was 1,20,000, what was the contribution? When the sales was 120, what was the contribution? I know the formula for contribution. The formula is sales into PV ratio, sales into PV ratio. So 120, 1,20,000 into 25%, so that is 30,000, right? That is 30,000. So that is 30,000. So that is my contribution, right? That is my contribution. Now, this is my contribution and 8,000 is my profit. So how much is the fixed cost? My fixed cost will be obviously 30 minus 8, that is 22,000. That is 22,000. Okay, that is my fixed cost. That is my fixed cost, which is 22,000. Now, I want the break-even point. The formula is fixed cost upon PV ratio. So 22,000 divided by 25%. 22,000 divided by 25%. So that is 88,000 is the break-even point. Sir, is there any other alternative to do this? Yes, there is definitely an alternative. Like profit was given, how much? 8,000. I know margin of safety, I can calculate profit upon PV ratio. So 8,000 upon 25%. So margin of safety will be 32,000. Margin of safety will be 32,000. Right? So I got the margin of safety. I got that is 32,000. So total sales are 1,20,000. So break-even sales is equal to total sales minus margin of safety. 1,20,000 minus 32,000. That is also 88,000. So you can solve it using any of the ways you like. Okay, you can solve it like this also. You can solve the previous one also. So this is how I got the break-even point. Now he is asking you. Now we have already calculated the break-even sales 88,000. Okay, he is asking you what will be the profit when sales are 1,80,000. Now I have got the break-even sales as 88,000. Now what are the sales? Sales are 1,80,000. Okay, I know the break-even sales as 88,000. So what will be the margin of safety? 180 minus 88. So that is 92,000. So he is asking you what is the profit now. I know profit is equal to margin of safety into PV ratio. I know profit upon PV ratio gives us margin of safety, right? So profit upon PV ratio gives us margin of safety. So similarly, margin of safety into PV will give me profit. So 92,000 into 25%. So that is 23,000, which is my profit, which is the answer for this question. It is the answer for this question. That is 23,000. I hope all of you have understood this. I hope all of you have understood it till now. Next question. Sales required to earn a profit of 12,000 rupees. Okay, how much is the sales required to earn a profit of 12,000 rupees? Again, it is very simple. Desired sales we want. Desired sales we want. We know the formula: fixed cost plus desired profit upon PV ratio. So fixed cost, we have calculated it before. You remember? Fixed cost, we have calculated 22,000 rupees. How much is the desired profits? We want to earn a profit of 12,000. Upon what is the PV ratio? 25%. So 22,000 plus 12,000. So that is 34,000 divided by 25%. So that is 1,36,000. So you sell this much and you'll get the profit of 12,000 rupees. You get a profit of 12,000 rupees like that. Okay, so desired sales formula can also be used. Okay, and what is the margin of safety in the year 2020-21? Margin of safety, we have already calculated the break even as 88. So from 1,40,000, reduce the break even sales. From total sales, if I reduce the break even sales, I'll get the margin of safety. So 1,44,000 minus 88,000. So my margin of safety will be 52,000. Students, I hope you have understood each and every solution. Okay, I hope you have understood all the solutions. Go through it one more time if you want, okay, and tell me if you are facing any difficulties. Tell me if you are facing any difficulties. Sir, can we use some other formulas and all that? See, this is marginal costing. You can use any formula you like. There are innumerable ways to calculate all this. Like you can use from fixed cost, you can go from profit, you can go from margin of safety, break even, total sales. There are so many formulas. Okay, you can use any formula you like. Okay, but the answer will be the same only. Answer will be same. You can use any formula you like. Everybody clear? Come on, everybody clear? Perfect. If you are having any difficulty, if you haven't understood any particular calculation, please let me know. Okay, sir, we have not understood how we have got this or that, whatever. Okay, if you haven't understood anything, please let me know. And there are many formulas to get this. Okay, many formulas. My suggestion will be to first of all visualize it very properly. Students, I'll suggest you, please visualize very properly. Like at break even sales, no doubt my profit is zero, but my contribution equals my fixed cost. In profit, in margin of safety, whatever contribution I'm getting, that represents my profit. Okay, the margin of safety. Understand? Like that. The more your visualization is proper now, the faster you'll be able to perform the calculations. Now, students, coming to the break-even analysis or the break-even analysis, we have already discussed a point of no profit, no loss. The formula is very simple: fixed cost upon contribution per unit. But the break-even point can be of three types: a normal break-even point, a cash break-even point, or there can be a multi-product break-even also. Suppose you have to find the cash break-even point. The formula will become cash fixed cost upon contribution per unit. So what is the difference between fixed cost upon contribution per unit and cash fixed cost upon contribution per unit? Basically, from this fixed cost includes depreciation also. This fixed cost will not cover depreciation. So From this fixed cost, if I reduce depreciation, I'll get cash fixed cost, and cash fixed cost upon contribution per unit will be cash break even. So which will be smaller figure and which will be bigger figure? Obviously, this is smaller. Cash break even, I do not have to recover my depreciation. So this will be a smaller figure, this will be a bigger figure. Okay, break even will be bigger figure and cash break even will be lesser. That will have only cash fixed cost in the numerator. Now, suppose if you are making 2-3 products at a time, okay, you are making 2 to 3 products at a time, then the formula is the same, only fixed cost upon contribution per unit. But the problem is, I'm making 2-3 products, so how to get the contribution per unit? Okay, so all products are different. Okay, everybody is having a different contribution per unit, and their sales mix is different. Okay, so how do I get the composite break even sales point? Okay, composite break even contribution. See this. If their sales mix is different, remember that you always have to calculate the composite contribution per unit. How do I calculate the composite contribution per unit? The formula is actually very simple. Just you have to multiply them in their ratios. That's nothing else. I'll give you one example. See this. See this one. This contribution multi-product break-even analysis. Arna Limited sells two products, J and K. The sales mix is 40 rupees per unit of J. Sorry, 40 units of J and 3 units of K. Okay, so what is the sales mix? The sales mix is 40 for J. Okay, 40. Okay, I think my computer has hanged a bit. Please. The computer itself has hanged actually. The I tab is not working. Just give me a second, please. Okay, fine. Pen itself is not working. Students, the pen is not working. My S pen of the tab. Anyways, chalo, I'll try to explain you the things. Okay, don't worry. I'll try to explain, and if something is left, we'll try to cover it in the next chapter. Okay, in the next lecture. There's technical difficulties. Anyways, chaliye. So where were we? We were actually discussing the multi-product break-even analysis. Suppose, for example, there are two units. Okay, the one is J and second one is K. Okay, one unit is J and the second unit is K. Okay, now the sales mix is 4:3. Remember that. Like, it means what? If I'm selling 4 units of J, then I'm selling 3 units of K, right? Their contributions are in the ratio 40 and 20. Their contributions are given 40 and 20. Now understand this thing. So I am selling 4 units of J and I'm getting 40 rupees per unit for J. Okay. Plus I'm getting 20 units for K and I'm selling 3 units for that. So out of a total 7 units which are getting sold, 4 for J and 3 for K. Out of the total 7 units, 4 are for J and 3 are for K. Right. So rupees 40 for J and rupees 20 for K. Now you have to use this formula. Can you see this? Actually, I would have written, but the pen is not working. That's why I was not able to do that. So 40 rupees into 4 by 7 and 20 rupees into 3 by 7, like that. Are you getting the point? So 40 रुपए जो J का है, जो एक यूनिट पे मिलता है आपको, ओके, हर 7 यूनिट में 4 यूनिट किसका है, तो जे का है. सो आउट ऑफ टोटल द सेल्स मिक्स इज 4:3, यानी 7 यूनिट्स एक साथ बिकते हैं, 4 जे के 3 के. Out of a total 7 units, 4 units are of J. Okay, so the ratio is 4/7. So this 40 rupees I'll earn in the ratio 4/7, and this 20 rupees which I'm earning on K, this I must multiply by 3/7. Okay, so now I'll get my composite contribution per unit, that is 31.43. Now whatever is your fixed cost divided by the composite contribution per unit, now you'll get the total quantities. And once you get the total quantity, that is the total break-even point, into 4/7 will be the units for J, and into 3/7 will be the units for K. I hope it is clear for everyone. I hope it is clear for everyone. Students, is it clear? I'm repeating it again. The sales mix is 4 units of J and 3 units of K. The contribution margins per unit are 40 rupees for J and 30 rupees for K. Fixed costs were given 6,16,000. So what we did is, basically we found the composite contribution per unit. How to get that? 4 units for J, 3 units for K. So total 7 units. Okay. So 40 rupees I'm earning in the ratio 4/7. Okay. 40 rupees into 4/7 and 20 rupees into 3/7. So my composite contribution comes to 31.43. Your total fixed cost divided by the composite contribution per unit. So 6,16,000 divided by 31.43, I get 19,600 units. Now this 19,600 units which I have got, okay, I have to divide it in the ratio J and K in the ratio of 4:3. Okay, so I got 11,200 units and 8,400 units for respectively for J and K. So this is how we actually solve for this. Okay, this is how we actually solve for composite contribution per unit. Now students, there are 3 types of break-even charts which we normally make. So first is a normal break-even chart. Students, just pay attention to the lines you have to make. Three lines. Just pay attention to the lines which you have to make. If you are making a break-even chart, the first line you have to make is the sales line. Can you see there is a sales line going up? The second is the total cost line, and third is the fixed cost line. Okay, so remember this. When you have to make a break-even chart, sir, in exam is a question on break-even chart is asked. Yes, beta, on questions on break-even chart have been asked in exams. Okay, so three lines you have to make. See the first line, total cost. Second, total sales. Okay, so I'm having the total cost, I'm having the total sales, and the third one is fixed cost. My question, is there variable cost line? No. Is there variable cost line? No. Is there profit line? No. There is no profit line. There is no total variable cost line. There are 3 lines: sales, total cost, and fixed cost. Sales, total cost, and fixed cost. Remember that. Now, if I remove the fixed cost line, I'll be having 2 lines: sales and total cost. If I remove the fixed cost line, and if I just simply draw the graph, I got the second one. See this one. That's a contribution break-even chart. Which lines I have removed? I have replaced the fixed cost line by a variable cost line. I have replaced the fixed cost line by a variable cost line. Okay, so the 3 lines in a contribution break-even chart becomes total sales, revenue, total sales, total cost, and the variable cost. Okay, so total sales, total cost, and variable cost, they are going to give you contribution break-even chart. Okay, contribution break-even chart. So this is again very simple. Okay, sir, how to make this lines? Better, total sales line always start from 0, because when you sell 0 quantity, you get 0 sales. Total cost line never starts at 0. Total cost always starts at the level of the fixed cost. So when you were making the first chart, the fixed cost is 1 line and the total cost will start the fixed cost. The total cost line, see, it is starting at the fixed cost itself. Okay, so remember that. So total cost never starts at 0. It starts at the level of the fixed cost. Okay, and the total sales, it always starts at 0. Fixed cost is a flat horizontal line. We were making a normal break-even chart. These are the 3 lines. But when we are making a contribution break-even chart, the three lines are sales, total cost, and the variable cost. Variable cost also starts at zero. Sales also start at zero. The gap between the sales, see this graph. See the gap. Can you see this? Can you see this? This gap is nothing but the contribution. Sales and variable cost. The graph, the gap between the sales and the variable cost gives you the contribution. You have to show that. Also, you have to show. See this graph, this gap between the variable cost and the total cost is always the same. This represents the fixed cost. The gap between the variable cost and the total cost always remains the same, which represents the fixed cost. Total cost again is starting at 200. It is not starting at zero. It is actually representing the fixed cost. Okay, that's the second chart. The third, profit volume chart. A profit volume chart will have only two lines: volume, profit. It's quantity and profit. Okay, at zero quantity, the starting point is always the fixed cost loss. See this. At zero quantity, you are always at a loss. See this. At zero quantity, my start point is negative 200, which is my loss, which is my fixed cost actually. And wherever you touch this line of the number of units is the break even point. This line, sir, what is this line actually? This line is showing you the profits. This line is showing you the profits. Okay, so wherever you will connect this line, okay, the y-axis is showing the profits and x-axis is actually showing the number of units. Okay, remember that y-axis is showing the profits losses and x-axis is showing the number of units. So I can say at 1000 units somewhere, okay, I'll be touching this zero line, I'll be touching this units line. Okay, so basically that's the break even point at somewhere around 1000 units. Then how to draw this graph? I'll say give you some suggestions. First, draw the profit line, minus 200, minus 150. So these are the profits at various levels. Start at the fixed cost level. So we are starting with negative 200. Okay, always negative. Why? Because we always are at a loss. When there is a zero production, when there is a zero production and sale, your fixed cost is entirely the loss. Next, do calculate profit at any one level. Suppose for 1600 units, you have calculated the profit above. Now join that point and this negative 200, wherever it will intersect the axis, that will give you the break-even point. Okay, wherever it will intersect the x-axis, it will give you the break-even point. So calculate the profit first. At zero output, you are already at a loss. So you know the starting point. But also calculate profit at least any one point, maybe 800 units, maybe 1600 units. Calculate profit at least one point. Join these 2 points and you will get where exactly do you get the break even. So this is how this is what we have to do in this. Okay, that's the profit volume chart. There's a profit volume chart. Now students, have you all understood this profit volume chart, the break even chart and the contribution break even chart, all three charts? Have you understood? So three lines what we have to draw, like when it's a contribution break, when it's a normal break even chart, total cost, total sales, fixed cost. When it's a contribution break even chart, so total cost, variable cost and the sales line. Okay, so these three lines you have to draw. The profit volume chart, you just have to draw the y-axis for the profits and x-axis for the quantity. That's it. Okay, just draw and connect the line. Now students, this question I'm giving you for homework. You have to draw profit graph for products A, B and C and find the break-even point. This question was asked in a recent exam. This question was asked in a recent exam where you were given actually 2-3 products. Okay, where you will given 2-3 products, and with this 3 products, what you will do is you will try to calculate the composite profits and then you will try to connect them. See this, I've tried to calculate the cumulative profits 1000, 3250 and 250 and you try to connect them. Okay, so this you will try it as home. Okay, you will try this as at your home. This was asked in an exam, that's why I'm asking you to do this. Okay, there were 3 products, so we'll calculate the cumulative profits. So I'll say that at 7500 quantity my profit is 1000. At 15,000 quantity my profit is coming 3250. At 17,500 units somewhere my profits is 2500, and then I'll connect this 2500 to this initial loss of 5000, and wherever it will intersect the x-axis, that will be my break even point. Okay, so this is how you have to do this profit volume graph. Okay, so try this at your home. Actually the pen is not working, so I'll stop here for today. Okay, I'll stop here for today. So marginal costing is not yet done. Okay, it's not yet fully done, because I actually wanted to take a few examples for this one, like the applications of decision making. Especially I have to teach you, like what if there is a limiting factor, if some raw materials are there in limited quantities. I have to teach you that, so I'll be covering that in the next one. Okay, I'll covering in the next part of the session. And one more thing is there, this is angle of incidence. Angle of incidence is basically the point of intersection of the sales line. Okay, is the what do you say, is the point of intersection between the sales line and the total cost line. The more it is wide, it is better for us. The more it is wide, it is better for us, because the like, if it is good enough, if it is big enough, okay, it means it is going to give you very high profits if you try to increase the volume. So that angle of incidence is after the break-even point between the total cost line and the sales line. Okay, the total cost line and the sales line. So that angle has to be very big enough for us to earn a greater revenue. Okay, that is the angle of incidence. Okay. So I'll stop here for today. Okay, I'll stop here for now. Okay, thank you so much for joining me. Tomorrow we'll complete this. Tomorrow actually is a holiday, right? Tomorrow is 19th. Okay, because of Ganesh Chaturthi and festivals, other festivals like Samvatsari. So tomorrow we are keeping off, right? So day after we'll be meeting at the same time, and day after we'll try to conclude this. If by chance something remains, then we may schedule another session to complete it, because we are not in a rush, that we may either extend the lecture, or we may keep another revision for maybe 1 hour or two or something like that, and we'll finish it off whatever is pending. Okay, so don't worry about that. Okay, so remember that we'll be taking another session day after tomorrow, and we'll try to complete whatever is left. Thank you so much. I'll see you day after. Take care. Bye bye. Keep liking the video, keep sharing it. Okay.